Hello everyone, thanks for checking out my video. The US stock market rallied last Friday to kick off November as Amazon led big tech stocks into the green, with the market brushing off a disappointing jobs report. Despite the rally, major indexes wrap up a choppy week in the red zone. Concerns are circulating about big tech's high spending on AI with limited results, coupled with uncertainties surrounding one of the most closely contested presidential elections in the US history. Besides the election, we have the FOMC meeting coming up this week as well, along with more corporate earnings reports. This is going to be a massive and impactful week, so stay tuned as we unpack some of these developments in this video. Before last Friday, we had a bit of sell-off in the tech industry as corporate earnings and forecasts from Meta and Microsoft failed to impress investors. But the US stock market staged a late week rebound as Amazon surged more than 6% after strong earnings and Intel jumped close to 8% on a positive outlook. Throughout the week, the earnings from the big tech or Mag 7 companies were actually mixed. Here's my personal take on their earnings. Google's results were very solid and its outlook is pretty promising. Meta and Microsoft results look decent as well, though the market didn't seem to like the forecast of a high capex for Meta and also a slower growth in Microsoft cloud business. As for Apple, while it reported solid top and bottom lines, but there is a bit of uncertainty over how a rollout of their new AI features will translate into sales of iPhones and other devices. Apple was also very cautious on their forecast and guidance for the upcoming crucial holiday quarter. At the same time, my view is that they are struggling to rebound in the very competitive China market. Finally, we have Amazon, who beat estimates for quarterly revenue, and more importantly, it gave a strong fourth quarter sales guidance. This is why the share price rallied the most after it reported its earnings, as compared to other Mag 7 stocks. On a side note, the US economy added only 12,000 jobs in October, which is way lower than the expectations of 100,000 jobs. The unemployment rate meanwhile came in at 4.1%, which is in line with estimate. The huge miss in the numbers did not spook the market because the government did warn that the job numbers were affected by the recent hurricanes and the strike activity by Boeing workers. Alright, for the upcoming week, I guess all of us know that the biggest event of the week or even the year is none other than the US presidential election on 5th November, Tuesday. This is probably one of the most closely contested presidential elections in US history. The election results are likely to move the financial markets because the impact of their respective policies will be reflected in the trajectories of corporate profits. We are talking about a lot of industries here, from the banks to healthcare, from small cap to large cap companies, and even the cryptocurrencies and their related stocks. Apart from the election, investors will also be closely watching the FOMC meeting that is taking place on 6 and 7 November. The next Fed decision on the interest rate is scheduled to arrive on Thursday, 7 November. The market is expecting the central bank to cut interest rates by another 25 basis points. But how Jerome Powell and his team respond to a cooling labour market remains a key focus for investors. To highlight, the latest policy move will come just 2 days after the election, adding extra significance to the Fed's decision. Okay, as the week unfolds, don't forget, there are still many companies who are going to report their earnings. Some notable names include Palantir, Supermicro Computer, Airbnb, Sony, and Arm Holdings. Well, I guess it goes without saying that this coming week is likely to bring another round of elevated volatility. Okay, let's now move over to the technical charts. The broader market index SPY looks a little bearish to me, but hang on, before you start shorting the market, I must say this coming week's election and FOMC meeting can swing the market in either way. No one can predict which direction it will go. Therefore, instead of predicting the market direction, let's watch for the key support and resistance levels. Alright, why I say SPY looks bearish because first, there is this gap down. This is bearish because it's like everyone was rushing for the exit door, either too eager to take profits or just dumping shares out of fear. And when everyone squeezes through the same door, you have this gap down. What didn't help is that the gap down was supported by a higher than usual volume. and also a big fat red candle. And then on the very next day, that candlestick looks like a bearish gravestone candlestick to me. The long upper shadow suggests that the bullish advance at the start of the trading session was overcome by the bears by the end of the session. To put it simply, bulls tried to bring the price up to fill that gap down, but got rejected. So come this week, stay cautious, not just because the chart looks a little bearish, but also because of the two major events that I have just mentioned. Alright, on the downside, watch that 568 level closely. Apart from being the 38.2 Fibonacci support level, this is also where the 50 moving average is currently at. A break below this level, it gives us a very high probability to head towards 562 level. This is also another double support level formed by that blue line, as well as a common rebound point, which is the 50% Fibonacci level. This also means if SPY doesn't bounce from here, then we can say that the uptrend has reversed, at least in the short term. And I wouldn't even be surprised if bears start taking out the critical 61.8 Fibonacci level at 556. On the other hand, if the recent pullback is just a small break from the market, then the bulls would want that gap down to be filled between 575 to 579. If the market reacts positively to the election results and if it rallies to fill the gap, then I would think the bullish momentum could easily bring SPY towards 580's range, probably going near the all-time high. Just to add on, as the election result won't be out early in the week and Fed's decision on rate cut is on Thursday, don't be too alarmed if the market continues to go sideways or pull back in the early half of the week. Basically, just pay attention to the support levels that I mentioned earlier. They are potential levels for SPY to bounce if the recent pullback proves to be a small breather for the market. Moving over to Apple. So in my previous video, I shared that if the area 226 to 227 breaks, I would expect Apple to touch the 221 support level at least, with the MACD continues to curl down. Well, Apple did exactly that. It kissed 221, went down a tiny bit more to 220 before closing at 222. Alright, for this week, once again, watch this 221 support level closely. If it breaks, then obviously the next level to watch would be 216. If you were to ask me if 221 breaks, I would say Apple is pretty bearish because that's breaking two double support levels in just 1 week. From there, I wouldn't be surprised if it continues to fall towards the critical 61.8 Fibonacci level at around 212. This 212 level has to hold. I repeat, it has to hold. If it doesn't, check out the chart. There isn't much support below, which means more downside can be expected. As for the bullish thesis, it's kinda straightforward. First of all, it has to stay above 221. Bulls will have to protect this second double support level. Then the bulls will have to reclaim the next double support level at 227, which is formed by the 50 moving average and the 23.6 Fibonacci level. But just to note, when the share price falls below a support level, the support level will then become a resistance level. So yup, bulls may face some difficulty in reclaiming this double support turn double resistance level. However, if Apple manages to overcome this big hurdle, then I think Apple can easily head towards 230's range again. Let's now jump over to Tesla's chart. Wow, 5 straight red candles in a row. Okay, I got to be very honest with my viewers. To be frank, I thought Tesla could push a bit higher after the post-earnings surge. It actually did go higher by hitting 270's range last Monday, but I didn't expect it to come back down that soon. Well, this is why we are always learning in the world of the stock market. Anyway, for the downside, quite easy to watch. Only two key levels. The first one is the 50% Fibonacci level at 243. That's usually a pivotal Fibonacci level if the existing trend is still intact, which means if the short-term uptrend is still valid, then Tesla should bounce around this area. Coincidentally, this is also where the gap up level is, which makes it even more important. If this level gets breached, then Tesla is giving up the gap up gains from post-earnings. From there, the huge gap is definitely the bear's target. They would of course want to fill the entire gap, But before that, the bulls will likely put up a good fight, and the support lies at around 235. That's where the critical 61.8 Fibonacci support level and the 50 moving average are, forming a double support level. Okay, I don't think you need me to tell you that if this double support level breaks, it's gonna be waterfall time. Given how volatile Tesla stock is, I would expect the whole gap to be filled, which means we could be back to where we were before the earnings. Alright, on the other hand, if somehow there is a catalyst to push Tesla higher, whether is it Trump's victory or other stuff, then Tesla should easily go back to 250's range. In fact, if there is really a catalyst, I would expect Tesla to reclaim the 23.6 Fibonacci level at 259. In other words, to hit 260's range. And for a full-blown bullish momentum, we need Tesla to break the recent high of 273. When that happens, then more upside could be unlocked. That's when I would see a high probability for Tesla to touch the gap between 280 and 289. Okay, let's now have a look at Google's chart. For the past few videos, I have been sharing about this potential bullish inverse head and shoulder pattern, though it's not the most ideal or textbook version. I specifically shared that if Google breaks above the neckline at around 169, we could easily see 180's range. Well, Google did so last week as it gapped up and hit 182. But, got to be honest with you, with its strong earnings, I didn't expect Google to falter so soon. By the end of last week, Google has already filled the entire gap up. But in case you don't know, gaps generally get filled all the time. So it's nothing too alarming for that gap to be filled. But right now, it is at a pivotal point. We have to see if Google can bounce from here after filling the gap. For the upside, watch for two levels, 169 and 174. 169, as mentioned earlier, it's the so-called neckline for the inverse head and shoulder pattern. On top of that, it is also the 50% Fibonacci level and where the 100 moving average is. In other words, it is a triple support level. This is probably the reason why Google kissed this level during intraday last Friday and bounced back up. Therefore, if Google can continue to stay above this level, it is a positive sign. But for us to call Google bullish, it needs to reclaim that critical 61.8 Fibonacci level at 174 and more importantly, stays above it. We don't want that peekaboo moment we saw last week, where Google couldn't even sustain one day above it. Alright, in terms of the downside, apart from the 169 triple support level, pay very special attention to the 50 and 200 moving averages at around 162 and 161 respectively. A break below both levels is a bearish sign from Google because it is also breaking below this consolidation area where Google was before its earnings. But hang on, don't panic yet even if Google goes below both the moving averages. As I have mentioned in my past videos, watch that 200 moving average. There were two occasions for the past 1.5 years where Google fell below it for a while and then reclaim it soon after. So the point here is pay very special attention to the 200 moving average. If Google falls below it briefly, it's okay. The key thing is Google has to reclaim it soon. If it doesn't, then it's very bearish. By the way, given its latest solid earnings, if Google does go near the 200 moving average, I may consider picking up some shares. Not financial advice, okay? Okay, moving over to Meta. Meta's chart is quite easy to read. There are two key levels to watch, 602 and 561. For the level 602, okay, maybe give and take a little bit, say between 600 and 602. If you had noticed, Meta got rejected by this area on 3 occasions. This shows that people have been stepping in to take profits whenever Meta hit the landmark and psychological level of 600. In fact, if you dive in deeper, you will realize that on each of the 3 occasions, Meta did not close above 600. It basically went above 600 during intraday and then selling pressure pushed it down to below 600 when the market closed. Therefore, for Meta to be called bullish, very simple, it needs to print at least 2 green candles above this 600 to 602 area. From there, the 600 to 602 area will become a support level, and then the sky is literally the limit until sellers define another level of selling points. The other level that I mentioned to pay attention to is 561. As you can see from the chart, Meta has tested this 561 level on so many occasions since 23rd September, and each and every time, the bulls held the line. This simply means that if this level gets breached, we can expect a lot more downside. My personal take is, if that level breaks, there is a high probability for Meta to hit 549 at least. This 549 level is something that I have mentioned in my last video, and I think it's still valid. Okay, if we ever get to this 549 level this or next week, then of course the bears would want to fill that tiny gap, right? The gap is between 544 to 546. Okay, a very strong support zone will come in at around 536 to 542. This area used to be a resistance zone, but it has now turned into a support area. I don't know about you, but I will be considering picking up some shares here. That's if Meta falls to this area in the near term. Moving over to Microsoft, I stepped in for Microsoft last week. More on that later in the end thought segment. In terms of technical analysis, obviously Microsoft looks weak based on three things. First and foremost, it's the huge gap down. Secondly, it's that big fat red candle during the gap down. Thirdly, last Friday, the bulls tried to bring the share price up, but got rejected before it could even touch the gap down. Okay, in terms of the bullish thesis, it's quite easy to watch. Anything below the 50 and 200 moving averages, I will not label Microsoft as bullish. It needs to get above both moving averages, which currently sit at 420, then I will call it a bit bullish. Coincidentally, that is also where the 38.2 Fibonacci level is. So like I say, if Microsoft can get above 420 with nice green candles, that's positive and slightly bullish only, not to the extent of being very bullish. For us to call Microsoft very bullish, it has to fill the entire gap between 416 to 423 and then get above the blue uptrend line. Honestly, I think it's quite an uphill task for Microsoft given that the MACD has just crossed down and the death cross is about to happen, where the 50 moving average crosses below the 200 moving average. Okay, for the downside, watch out for 406. This is a decent support level as it is where the critical 61.8 Fibonacci level is. This is also roughly where I stepped in for Microsoft last week. But because it is an important support level, so if it breaks, it spells trouble for the share price in the short term. That's when I think we might briefly fall below 400 to hit that green support line at around 397. Alright, the ultimate support level or the so-called last line of defense lies at 385, which I think quite unlikely for Microsoft to break in the near term, unless something really negative happens. Alright, let's now move over to Nvidia's chart. Remember in my previous video, I mentioned that if a meaningful pullback comes, Nvidia can flush quickly and it could easily hit 131 where the first Fibonacci support level is. Check out the chart, Nvidia flushed down to 131 and bounced off this support level nicely. For this week, watch this 131 level again. It will continue to act as a support. Honestly, nobody knows what is the extent of the current pullback by Nvidia. But if the bearish momentum continues for whichever reason, be it due to the election or what, I do think we can expect Nvidia to continue flushing to around 124 where the next meaningful support level is. Pay very special attention to this 124 level because it is where the 50 and 100 moving averages are, and also where the 38.2 Fibonacci level sits, thus forming a triple support level. This level has to hold given how strong the support level is, because when the strong support level breaks, it usually spells a change in the trend, and that's when we can see Nvidia falling below 120s again. To put things in perspective, for Nvidia to fall from its all-time high of 144 to say 120, that's a 16% drop. It is in the pullback territory and almost hitting a crash zone, which is defined as 20% drop from its peak. On the other hand, if somehow the election results push the market higher, then Nvidia should be able to hold at 131 support level. And this is Nvidia, it can go down fast and it can go up fast as well. which means if the overall market bounces off the election result and or Federal Reserve decision on the rate card, then we could easily see 140s range again. I wouldn't even be surprised if we hit another record high. Okay, given how massive the swing in either direction it can be, I would urge traders and investors to step in with care if you are looking at Nvidia this week. Okay, let's now move over to the options trading section. No new trade to share this week, so I will just do a quick update on this trade that is going to expire in the upcoming Friday, 8th of November. This is a cash secure put on Tesla that was sold on 26 September with a strike price of 190. Back then, Tesla was on a nice short-term uptrend and showing a few bullish signals. You can find more information about this trade via the video linked at the top. In that video, I also shared about the risks of this trade, which were Tesla's quarterly delivery numbers and their robo-taxi event. If the numbers and news couldn't excite investors, the downside could be massive. Well, lo and behold, Tesla plunged from 260s range to 210s range, which was a close to 20% drop. But because I gave enough buffer for the trade, my 190 strike price wasn't breached. Then shortly after, Elon Musk came out to excite investors with his 2025 growth story during the earnings call. The stock then rallied to 270s range. Though the rally has faded a bit, I think it's quite unlikely for Tesla to breach my strike price this week. Because for that to happen, Tesla needs to plummet about 23% from the current price in 1 week. Is that possible? Well, it is not entirely impossible, but the odds are low. Perhaps if Trump doesn't win the election, and given how Elon Musk has been supporting Trump, who knows, the stock may plunge as a result. Let's see. Okay, some quick thoughts on the massive week ahead. First of all, I think that the market was finally showing and feeling the effects of an overbought situation as we had a sell-off last week led by the tech sector. As you can see from this image, it was all red last Thursday, with about $950 billion being wiped out from the stock market in just 1 day. But it turned out to be a Halloween scare as buy the deep crowd stepped in once again on Friday and we saw a rebound in the market. This has been the norm so far this year. Every pullback has been met by a rebound. This was why I stepped in for Microsoft last week. The buy decision was easy to execute because Microsoft results were actually pretty decent, but because it anticipated a slower growth in their cloud business, the market didn't like it and investors started to dump Microsoft shares. Personally, I thought it was a bit of an overreaction. As you can see from this image, it was the worst day for the company's share price in 2 years. But if you take a step back to look at Microsoft earnings, they are so much better than 2 years ago. Therefore, it was an easy decision for me to step in for Microsoft when it hit a support level. Anyway, I digress. So in my view, the near-term volatility is likely to continue, particularly with the election and FOMC meeting coming up. Just to add on, it is unlikely we get a result from the election on Tuesday given how closely contested this election is, which means the volatility could continue and extend throughout the entire week. And for me personally, volatility means opportunities. That was actually how I stepped in for Microsoft, taking advantage of the volatility brought on by its earnings. Anyway, historically, the US stock market tends to perform well in pre-election years like this one, with the S&P 500 currently up over 20%. However, returns often soften in the years following elections, which could weigh on the market performance in 2025 if the trend holds. With that being said, presidency itself has not typically been a primary driver of the stock market. While the president's new policies or a shift in investor sentiment may impact the market in the short term, perhaps for 6 months to a year, market returns generally remain positive over a presidential term as long as corporate profits continue to grow, which is the main driver. This outlook of course assumes there are no major financial crises, recession or black swan events. To summarize, in the short term, the market may be influenced by the election and the incoming president's policies. However, looking ahead, the growth story for big tech companies remains promising, at least in my opinion. And with more rate cuts by the Fed and a stable labor market and US economy, the outlook is still positive. To put it very simply, if you are a long-term investor, embrace the volatility. Use it as an opportunity to buy strong companies at a discount. Keep a long-term perspective and your portfolio should perform well over time. Okay, let's see how the market looks like after this week. I will see you in the next video. Do subscribe to my channel if you haven't, and don't forget to tap the like button, alright? Thank you very much.